Hey everyone, me Kevin here. Is the United States consumer absolutely screwed, and could we be walking into economic stagnation? The answer is yes, and in this video we are going to break down some of the latest drama from company earnings and the red flags that we're seeing their executives tell us. We're going to go right to the bottom lines. First, it's worth noting that today we did get a negative 306,000 job revision for the amount of jobs that were added in the United States over the last year from March to March. Yeah, it takes them like another 6 months to figure this stuff out. It's wild. But what does that mean? It means less people earning money who can contribute to the economy. And one of the things that's propping up this economy right now, potentially one of the only things, are jobs. And so a slowdown in jobs, along with potentially labor attrition, could lead to an even weaker consumer. This isn't even looking at what happened to Peloton today with another 25% decline. Glad we sold them over $100 a long time ago. It's not to mention what's happening with Foot Locker, where their fiscal year guide came in 34% lower than expected, leading their stock to sell off about 30%, blaming softening in consumer trends. We're going to go even deeper. So let's try to understand what exactly is going on here and get started right now. Quick note, I will shout out that our trade on TMF is working out great. A couple days ago, I sent out a buy and sell alert, as I do every single time I trade, to basically go long TMF. As in, that's what I was doing. I was going long. You know, what you do is ultimately up to you. But I send this to all my course members, and that trade is up about 20% in a matter of just 2 days. That's basically betting that the 10-year yield drops. So we'll keep playing that. We've got other trades going as well, so we'll see how those all go. Now, let's go jump on into these earnings figures.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Take a look at this. This is Macy's. And what's important here is the following. Macy's says, what we saw is the speed of delinquencies across all balances accelerate after Q1, primarily in June and July. Now, this is really interesting because we have had other earnings calls warn us about June and July. Look at Capital One. When you look at spend per customer, this has moderated and is now generally flat from a year ago. And the moderation in spending appears to be broad-based. We observed it across income bands and card segments. We've also seen it across both discretionary and non-discretionary categories. Okay, in English, they're seeing people spend less money on stuff they need and stuff they want. And it's not just poor people, or it's not just white-collar people getting laid off, it's everyone. And just wait for the stagnation argument. That's coming up. When you see a corporate executive say we might be going into stagnation, you better put some red flag antennas up in terms of how you're investing. We'll talk about that in just a moment. But anyway, I'm going to continue reading this because it's impactful. By the way, it's not surprising at all that this would sort of level out. This, by the way, is an executive way of saying, look, we had a big boom. Of course, we're having a return to normalcy, so some leveling out. That's fine. That is expected. But at what point does that become self-sustaining and we actually go into stagnation? Stagnation is not necessarily a decline, but a flattening, and then you stay flat. Let's keep reading. The consumer pulled way back in the pandemic, just an unprecedented amount of pullback. Now, this sort of has come roaring back on the other side, that I think for the individual, things are settling down. Basically, everyone shut down, then everybody spent a lot, now things are flattening out. Okay, that's fine. Is that maybe a leading indicator of concerns, or is it just sort of a reversion to the mean? Well, TBD. We see here Macy's goes on to say, in addition to this wall of June and July, that these are things that we can't control. That is the consumer's health. That macro is really having an impact on the consumer. And we know that the consumer is coming under pressure. That we believe the consumer has new realities, such as higher interest rates on auto loans or credit cards or student loan repayments coming due. Now, keep in mind, I personally don't think this student loan repayment issue is going to be as bad as people expect it all at once. Like people expect, oh no, students are going to have to start repaying loans. That means somewhere around 30 to 40 million Americans are going to have to pay about $383 more per month. And that's going to have this wall of consumer spending stopping. I don't think it's going to be like that, mostly because the Biden administration has enabled people to essentially take a free loan for the next year. Now, I want to be clear about what I mean when I say free loan. The Biden administration has said you can have essentially your loan, pay interest on it, and not make not make payments on it. So owe interest on it, but not make any payments at all if you don't want to for the next year. So you're still going to owe the interest, so you're still paying interest. So it's not free in the regard of interest. But if somebody came to you right now and said, hey, you got $30,000 of student loan debt, you don't have to make payments for another year, but you have to pay interest on it, which means you could delay when you start repaying for another year. A lot of people are going to take that choice. That is, in essence, a freely created loan. In other words, somebody comes to you and is like, hey, no application fee, no underwriting fee, no appraisal fee. We'll give you a loan right now for 30 grand. You don't have to make any payments for a year on it. But you owe interest in the meantime. Like eventually you'll owe that. It's not free in the sense that you're not paying any interest. But the point is you can delay for free for another year, essentially, right? And I'm going to confuse some people with this because people are going to think, but you're still paying interest. I come from the loan originating world where as a mortgage loan officer, when we made a loan, there was a charge, underwriting fees, processing fees, origination fees to create a loan. People don't have to pay anything. It's just like, all right, I feel like not making payments for another year. You can do that. You have that choice with no impact to your credit. And so that's why I actually believe what will happen with that group of consumers who are spending money or potentially not going to spend money is you'll kind of see this. You'll see this stair stepping down of people being able to spend that $383 a month or whatever, rather than this wall that people are anticipating. So you have kind of this slower drawdown of that consumer spend when it comes to debt and student loan repayments. Okay, great. Now, what else are we seeing, though, about jobs? Well, let's go to Randstad, which actually owns, these companies own like the Indeed.com, the Monsters.com, the ZipRecruiters, right? And what do they say? They say they're not seeing demand come back anytime soon. And they're wondering, when is the demand going to come back for hiring people? And what is the CFO here saying? Trends have decelerated significantly more than we're seeing in Q1. In other words, less people are getting jobs because less companies are looking for more employees. In fact, you're seeing more layoffs, especially in the white-collar segments, and that really hurts the job placement companies who can skew to that office worker rather than just the floor store retail worker, right? Here's Recruit.com, and what do they say? Our global HR business is heavily impacted by the economic environment. It is very important to continue investing for the future and improving the efficiency of our business while conservatively assuming a downturn followed by economic stagnation. This is the CEO of a hiring firm saying we could be facing economic stagnation. I actually wrote this down that this is much more likely than stagflation. I don't believe we're facing stagflation because stagflation implies that inflation is still running up and really running amok. Well, let's understand why I don't think stagflation is the issue. Take a look at John Deere right here. Here's a return to normal seasonality, but listen to this. Importantly, this is a real testament to our factory teams. And the real story is around margins, right? All three divisions saw lower than expected production cost inflation as our operational teams continued to deliver on real cost reduction activities, having eliminated many of the inflationary and disruption-driven costs over the last couple of years. Less inflation than expected, a lot less than expected. We've seen material cost inflation come down meaningfully throughout the year. We expect this trend to continue. What about Walmart? Walmart is worried about the consumer balance sheet weakening. And yes, we've seen inflation and wages go up. But listen to Walmart. There are reasons to be optimistic in employment and wages in terms of inflation. That is, we're not seeing those inflation pressures anymore. But the concerning side is the consumer balance sheet weakening. This is stagnation, folks. This is flat growth of company earnings and revenues, not supported by inflation anymore, inflation going away, but an economy that's just going flat, basically, which is weird because you still have the Atlanta Fed real, GDP estimates coming in at nearly 6%. Seems a little lofty and excessive. But let's keep looking at examples here, and then we'll draw some conclusions. Here's Home Depot. They literally say, inflation has certainly abated. Commodity is certainly down meaningfully from the peak year over year. We don't have increased inflation. Now, we're not expecting a deflationary environment where prices are going down, but the cycle of inflation is essentially behind us. These are huge statements here. Here's Target. We're happy to see inflation rates begin to moderate. That's going to create some pressure on our headline numbers because we can't just rely on inflation to create some growth anymore, right? So what are we seeing across the board here? Well, we're seeing a very clear and consistent story. We're seeing hiring slow down. This is ZipRecruiter. Employers continue to respond to the enduring macroeconomic uncertainty with caution. In fact, we expect to see attrition, say some of these job placement firms. Attrition is basically where you say, hey, we don't think people get laid off, but basically companies will stop hiring. So when people leave because they're done working at the company or want to move on or whatever, those jobs don't get refilled. That pushes pressure on consumers. So I want to be crystal clear here. While I am overall long the stock market, I do see near-term headwinds in stagnation. I don't see them in inflation. I don't see them in some massive breaking like a 2008. So I don't see a 2008, but that's my opinion. You could have a different opinion, and that's okay. I don't see inflation coming back up based on the data that I'm looking at. And you can make your own conclusions based on what you're seeing here. But let's talk about the implications for this. The implications are, and this is my belief, we are going to see flatness in many S&P 500 companies, consumer staples companies, and the discretionary of the discretionary. That is like the most choice of the discretionary companies are going to have the most pain. So it's like your TV companies, your PC companies, right? The companies that are really going to win in a low growth or flat growth environment, I think, are the pricing power companies. Now, I understand those have had some relative weakness over the last few weeks as we've had a little bit of a correction here. Not a big deal in my opinion. I actually see it as an opportunity because I think over the next few years, we're going to be in a stock market that says we need growth at like any growth we can get our hands on. And where's that growth going to be? Well, I think that growth, it's going to be smaller than expected. Don't get me wrong, it's going to be smaller, but it's not going to be in the Targets, the Walmarts, and the Home Depots anymore, or the John Deeres. It's going to be in the end phases. Massive price correction, huge opportunity in my opinion at these low levels. Stimulus funding, the microinverter tax credits, it is going to be in the Teslas, the Apples, the products that people are willing to go out of their way for. Those pricing power products will show the stock market this is where there is growth in a stagnated economy. Everything else I think will suffer. That's why Macy's and Foot Locker are suffering the way they are. Their stocks are going miserable. Why? Because the markets will likely shift to a growth at any cost mentality. That's my belief. So again, you can invest differently, but let's be very clear. I'm bullish on that segment, the growth segment of the economy, because when everything else goes flat, this will be the only place with a heartbeat, in my opinion. So I'm not here saying everything's great and all rosy and perfect. But do I believe in the super bear narrative that inflation's going to destroy us, the Fed's going to break everything, and we're going into the Great Reset? No, I don't believe that. I do believe there are hardships, but I look at this economy and this data through what I believe is a realistic lens. And that's why I position for companies I think are going to have pricing power in a stagnating economy. And if you like these sort of insights, make sure to subscribe.